Does this mean that you're expecting, say, labor and material costs not to come down as quickly as other sectors of the economy?
Yes, we think the pressure in the labor market will keep wage inflation running at a pretty good clip. We're still dealing with shortages as an outgrowth of the pandemic related to that. At the same time, we do see inflation coming off the boil. It will be slow and choppy, much as it has been over the past couple of months, but there are signs that the improvement will be more noticeable over the course of 2023. Combining the two, it does imply profit margins under pressure during the worst of the recession, which we see in the first half of the year, and then perhaps opening up a bit in the latter part of 2023.
And Gary, given the challenges we have seen, the earnings bar being lowered significantly in the past few months, does the earnings estimate coming from Wall Street sort of price in all of the challenges for the rest of the year?
Not yet, we don't believe. Those earnings estimates, we feel, have been quite optimistic throughout the year. They are coming down now, but we're still a bit ahead of the curve. We've been more cautious. Our earnings estimates have been below the consensus for quite some time. And we think that there's still some further downward revisions to come as we move through the worst of the slowdown, again, during the first half of the year.
When you talk about the unevenness of the inflationary impact, we just got those New Zealand inflation numbers. We're suggesting that this could be quite an elongated fight, right? Where do you find, I guess, some of the arbitrage opportunities when you're looking at which companies get affected or not affected in a more outsized way?
Well, some of the services companies in the U.S., they're more labor intensive, so they will be exposed to the pressure from rising labor costs, less scope to boost labor productivity, although we are seeing opportunities open up in robotics. Very strong investment there, which we think will continue for a time. But the more conservative, certain other areas of the economy, less sensitive to the economic cycle, and therefore whose pricing power should hold up a bit better, we find to be good defensive areas in the economy. Energy as well, we have a favorable view toward, in part because of the fundamentals in the market there.
Tech is an interesting one, right? Do you expect, even with all of the headwinds, the most recent kind of bad news story when it comes to the chip sector, that there is still value and opportunity in the medium term?
In the medium term, yes, and we look beyond the short term with respect to tech. We still view that sector favorably, particularly the large, financially strong tech companies here in the U.S. Notwithstanding the impact of a strong dollar on overseas earnings, the translation losses that have developed as a result of that, their financial health, and more importantly, over the longer term, medium term, the opportunities created by digitalization of the U.S. economy and economies overseas, we think will keep that sector of the market quite viable.
Gary, we have seen emerging market default bets rising for the longest stretch of time since 2016. Is this just the expectation that anything that happens in developed economies, especially here in the U.S., will be just much more for the worst for those developing economies? And are there any market bets that you could make there?
Well, we think the performance will become more dispersed over the next year. But for emerging markets generally, and economies overseas from the U.S., we think the combination of a global recession or something close to it, the strength in the dollar, and some of the geopolitical disruptions, even with a gradual recovery, a moderate recovery we're anticipating in China, will create a very difficult environment for emerging markets generally. But within that segment, we do think that performance will become more dispersed as we go through 2023.